MasterCard is nearly perfect. And nearly is a very important part of this sentence, because there are a number of things that people like Guy Spier, Akre or Thomas Russo love about this company. But there is also one aspect of it that changes this sunny picture quite a lot. So let's analyze MasterCard, let's see is it fairly valued, and then decide is it a good investment for us. So first, let's take a look at the recent financial results. The revenue is up by 14% year over year, net income is up by 28%, cash is down by 1.7%, and the debt is up by 3.5%. Cash and debt may spoil the picture a little bit, but all in all, these results are very impressive. If you were to invest $1,000 into MasterCard 10 years ago, you could buy around 13 shares, and today they would be worth something like $5,204. But that is not all. Through the 10 years, you would receive $165 as dividends. So if we add the current value of shares and the dividends, we get $5,369. So that is a gain of 437% in 10 years. That is super impressive. But before we come to any conclusions, we have to remember that past results are just that. Results that happened in the past. They don't have to be the same in the future. Actually, they can be quite different. So let's look a little bit closer at MasterCard. Individual insiders, that is an X. Only 0.1% of the company is owned by individual insiders. And we would like to see this number over 2%. So unfortunately, the management does not have its skin in the game. And are they buying? That is a check. One of the directors bought 1,000 shares around half a year ago. So not a lot of movement, but it's better than none. And do super investors own this company? That is also a check. 17 super investors put their money into this company. And among them, we see people like Akre, Guy Spier, Thomas Russo, or Warren Buffett. So another interesting signal we can take into consideration. And are super investors buying right now? That is an X. In the last quarter, they bought over 600,000 shares and sold over 1 million shares. So a meaningful difference. Return on invested capital. That is a check at 43.1% 10-year median returns. And we want to see this number higher than 10%. So such result is absolutely incredible. That shows us that the management is doing a really good job. And free cash flow growth? That is a check at 14.2% 10-year compound annual growth rate. And also here, we want to see this number over 10%. So free cash flow is really nice, but not exceptional. And what do we know about net profit margin? It is a check at 44.8%, and the industry average is 32.3%. So not only the industry on average has some beautiful margins, but MasterCard is doing substantially better, and it gives them incredible pricing power. And now let's take a look at share buyback. It is another check with 22.1% of shares bought back in the last 10 years. So long-term investors own a bigger portion of this company without investing any extra money. Okay, so finally, let's take a look at the debt. It is a check. It would take 1.5 years to pay the long-term debt with a current free cash flow. And we like to see it below 2 years, so MasterCard has its debt under control. And with higher interest rates, that may be very important. The dividend yield is 0.6%. So in the last 12 months, shareholders got $2.28 per every share through dividends. I have to say that this dividend is not very impressive, but let's take a look at the payout ratio. That is an X at 19.4%, and we want to see it somewhere between 20 and 50%. So it is almost there. What it all means is that MasterCard is distributing through dividends 19.4% of its earnings. That is a healthy amount. It is a meaningful portion of the earnings, but at the same time, the company is keeping enough cash for its growth and other needs. Talking about growth, what do we know about dividend growth? It is a check at 17.9% 5-year growth rate, and the dividend is growing every year for the last 12 years. So that is really nice. This dividend is not only sustainable, but also we can expect it to grow in the future, making our long-term investment more and more profitable. Before we value MasterCard, I just wanted to let you know about our new improved stock ranking. It is a tool that can simplify and speed up your process of finding investment ideas. It gives you a bird's eye view of all the companies we analyzed on this channel with updated prices, which allows you to find best deals fast. And what is even better is that you can customize it the way you want to. So finding companies with the lowest debt or highest dividend yield or with the biggest number of super investors is just one click away. If that sounds interesting, then you can get access to it by becoming a Patreon for just $5 a month. Thank you so much, and let's get back to the valuation. Price to earnings ratio is 34.8, so it is rather on the expensive side. But to properly value MasterCard, we will have to estimate its growth for the next 10 years, and we will make 3 scenarios: low, medium, and a high one. So in the low scenario, we will estimate a growth of 10% for the first 5 years and then 8%. In the medium, 12% and then 10%. And in the high scenario, 14% for the first 5 years and then 12% growth. Now, why did I use such estimates? Well, if we look at the 10-year annual growth rate, we see that the revenue went up by 11.6%, free cash flow by 14.2%, and earnings per share by 16.7%. So all scenarios seem realistic, and even the high one is a bit on the conservative side. And with such estimates, the intrinsic value in the low scenario is $213, in the medium scenario $247, and in the high scenario $287. But these are not the prices we should be looking for, because we have to always add a margin of safety. I use a 30% one. But you can apply any margin that is right for you, that makes you feel comfortable. It is just important to remember that the bigger it is, the safer the investment. So with such a margin, we get in the low scenario $149, in the medium $173, and in the high one $201. And the current price is around $404. So it is all in the red. MasterCard is currently rather expensive. This is a great company. Super return on invested capital, great margins, low debt, secure dividend, and so on and so on. But finally, we get to the one thing that makes this investment a bit questionable: the price. It is just expensive. Let's see, for example, how much did most of super investors pay for this company. Guy Spier paid probably something around $86. Akre and Warren Buffett, $25. Thomas Russo, something close to $14. And of course we can say that the company was smaller, so the price was lower. And yes, that is true, but if we look at the price to earnings ratio, they were buying probably somewhere between 15 to 26, so substantially cheaper. And most of them did not make a lot of significant changes to this investment through the years. So this buy and forget strategy is paying off very nicely for them. So MasterCard has all the characteristics we would like to see in a company. But an investment makes sense only if we don't overpay for it. And don't get me wrong, it is interesting and maybe it will go up in value into the future. But I think we can find better investments out there. Not necessarily better companies, but better investments. And talking about better investments, you may want to check out my analysis of Visa by clicking over here. Thank you so much for watching and see you in the next one.